Trying to make sense of the investment world today. Well, it can feel like predicting the weather months out, can it? Stocks jump, they fall. It's enough to make anyone feel a bit uneasy.
Absolutely. And all that noise, all that anxiety.
Yeah. But then there's this one figure, Warren Buffett, who just seems to offer, I don't know, a sense of calm, a path that actually works. He's like that steady hand in a storm.
He really is. And
Yeah.
that's what we want to dig into today. We're looking at Robert Hagstrom's book, The Warren Buffett Way, to pull out those core ideas, those principles that last.
Right, and we want to do it in a way that helps you, the listener, get the essentials without getting bogged down in, endless details, quick insights.
Exactly. Hagstrom's book, especially as the forward points out, really focuses on the investment thinking that holds up no matter what the market's doing day to day.
That's the key, isn't it? Ideas that work through booms and busts. And Buffett didn't just pluck these out of thin air. He built on the work of some really smart people.
That's a great point. Understanding those influences, Graham, Fisher, Munger, it helps you see why his approach is so robust, so enduring.
So let's see these ideas in action. Where better to start than the beginning? The Buffett partnership back in the 50s and 60s. That was his first real shot at managing money for others, right? What did that look like?
Well, it started small, 7 limited partners, about $105,000 total. But the structure was clever.
How so?
The partners got a guaranteed 6% return first. Then, of anything earned above that, Buffett got 25%, and the partners got the other 75%.
So his interests were immediately tied to theirs. If they did well above 6%, he did really well.
Precisely. It incentivized strong performance.
Yeah.
And boy, did he deliver.
The numbers are just staggering, aren't they? A 29.5% compounded annual return over 13 years.
And get this, the partnership never had a losing year. Not once. Even though the Dow Jones Index dropped in 5 of those years.
Wow, that comparison really highlights it. Did he set specific goals back then?
He did, a very ambitious one. Beat the Dow by 10 percentage points every single year.
Ambitious indeed. And did he manage it?
He smashed it. On average, he outperformed the Dow by 22 points annually over that period.
Incredible. So what was he actually doing? What were the strategies in those early partnership days?
Primarily, he was focused on buying controlling stakes in companies, both public ones and private ones, getting enough ownership to have real influence.
It's funny to think about now, but the book mentions his office in Kiewit Plaza in Omaha from 1962. Tiny, no computers, no stock tickers, flashing away.
Right. Less than half a tennis court, it says. It really shows a focus on deep business analysis, not just reacting to market blips.
Yeah, a different world. And then came a really big moment in 1963 American Express.
Ah, yes. The salad oil scandal.
Right, a huge company suddenly hit by this massive scandal, and the stock just tanked. What did Buffett do?
Well, this was classic Ben Graham playing out. A fundamentally strong company facing a temporary but serious crisis. The market panicked. The stock price plummeted.
Creating an opportunity.
Exactly. Buffett saw the underlying strength of the Amex franchise. So he made a huge bet, allocated 40% of the partnership's assets, $13 million back then, into buying American Express stock.
40%, that's conviction.
It really was. And it was pure Graham, buying when there's blood in the streets, so to speak, but only if the underlying business is sound.
And did that conviction pay off?
Oh, absolutely. Within 2 years, the stock had tripled. That single investment made the partners a $20 million profit. Hagstrom calls it pure Graham and pure Buffett.
It really sets the stage for understanding his influences, doesn't it? Which brings us to the education of Warren Buffett. We mentioned Ben Graham. He seems foundational.
Absolutely. Graham is often called the dean of financial analysis. His books, Security Analysis and particularly The Intelligent Investor, are basically the Bibles of value investing.
And what was Graham's central message, especially about what is an investment?
Graham made a very sharp distinction. An investment for him required thorough analysis first, and then it had to promise safety of your principal and an adequate or satisfactory return.
Anything else was.
Speculation, pure and simple. That rigorous analysis and focus on not losing money was core.
And the margin of safety, that's Graham 101, right? What? Can you break that down?
It's probably his single most important concept. It just means buying a security for significantly less than what you calculate its underlying or intrinsic value to be.
So buying a dollar for 50 cents, essentially.
Sort of, yeah. That discount, that gap between price and value is your margin of safety. It protects you if your analysis is a bit off or if things just go unexpectedly wrong, you build in a cushion.
Based on real stuff like assets, earnings, dividends.
Exactly. Tangible facts about the business, not just market sentiment.
Okay. But Buffett wasn't just Graham. Philip Fisher was another key influence,
Right.
right? How did he differ?
Fisher brought a different angle. While Graham looked for statistically cheap stocks, Fisher focused more on finding truly outstanding companies, businesses with great long-term growth potential.
Growth company.
Yeah, driven by things like strong research and development, great sales teams. He looked for quality and future potential more than just a low current price.
So what did he emphasize in terms of financials or operations?
Consistent profits, good profit margins, understanding costs really well, solid accounting. He believed sustainable growth came from efficiency and smart resource allocation.
And his research method, the scuttlebutt approach. Sounds intriguing.
It was very hands-on. It meant going out and talking to people, customers, competitors, suppliers, even former employees to get the real scoop on a company beyond just the official numbers, like investigative journalism for investing.
Getting the word on the street. And Fisher also had a view on diversification, didn't he?
He did. He favored concentration. Own just a few truly exceptional companies that you understand deeply operating within your circle of competence, as he called it. Better to know a few things well than many things superficially.
Makes sense. Okay, then there's John Burr Williams. His contribution seems more theoretical, valuation focused.
That's right. Williams wrote The Theory of Investment Value. He's really known for formalizing the idea of discounted cash flow analysis, or the dividend discount model.
Okay, break that down. What's the core idea?
It's basically that a stock's true value today is equal to all the cash you can expect to get out of it in the future, discounted back to the present.
So future dividends, or maybe earnings reinvested that eventually become dividends, what they're worth now.
Precisely. Williams famously said, a stock is worth only what you can get out of it. Even if earnings are kept in the business, they ultimately have to benefit the shareholder down the line.
Got it. Now, you can't talk Buffett without talking Charlie Munger. Their partnership seems legendary.
It really is. Hagstrom calls Munger Buffett's co-managing partner and alter ego. Their thinking is incredibly intertwined. Munger officially became Berkshire's vice chairman in '78, but his influence was huge long before that.
It often sounds like Buffett speaks for both of them, using Charlie and I.
Exactly. It shows how aligned they are. Munger's sharp analytical mind, his broader way of thinking about businesses and human behavior. It clearly shaped Buffett profoundly. And Munger chairs Wesco Financial, too, another Berkshire company. They're a unit.
Okay, so we have these intellectual foundations. Let's see how they played out as Berkshire Hathaway itself transformed. The original textile business, that wasn't exactly a home run, was it?
No, far from it. That's a really important part of the story. The textile operations struggled badly. Equity halved by 65. Losses mounted. It was a tough, declining industry. Buffett and his manager, Ken Chase, worked hard, but the returns just weren't there.
A tough lesson in industry economics. But even then, there was something else happening within Berkshire, right?
Yes, and this was key. While the textile mills were struggling, Buffett was actively managing the company's stock portfolio. It started small, maybe $2.9 million in stocks. By the end of his first year, it was $5.4 million. A couple of years later, the returns from the tiny stock portfolio were 3 times bigger than the returns from the entire textile division, which had way more capital tied up in it.
Ah, the writing was on the wall. Investment was the future, not textiles.
Absolutely. It showed where the real value creation was happening.
Which leads us to Geico, a name synonymous with Buffett and Berkshire. What was the attraction there?
Geico had this brilliant, simple strategy. 1, insure only lower-risk drivers. 2, sell directly to them, cutting out the agents and their commissions. Lower claims, lower costs.
Genius in its simplicity.
Totally. And Buffett saw this way back. He actually wrote a report on Geico when he was young, recognizing its potential. He bought and sold it earlier, but always kept an eye on it.
And eventually he bought the whole thing.
Well, after Geico hit some rough patches later on, Berkshire stepped in with major investments. And eventually, by 1996, bought the rest of it. It became a cornerstone.
Why was it so valuable to Berkshire, beyond just being a good insurance business?
2 things. First, it was consistently profitable on the insurance side. Its underwriting was good, which is rare. Second, that profitability generated massive amounts of float.
Float. That's the premiums collected before claims are paid out.
Exactly. It's money Geico holds on to, essentially borrowed from policyholders, that Buffett could then invest for Berkshire's benefit. It's like getting paid to hold money. A huge advantage.
Okay. Then there's General Re, or Genre, another big insurance acquisition, but that one had a rockier start.
It did, yeah. After Berkshire bought it, they found Genre had been underpricing its reinsurance policies. That meant they were paying out more in claims and costs than they were taking in premiums. That's called having a positive cost to float. You're losing money on the underwriting.
Not ideal. And then 9/11 happened.
Right, which hit the reinsurance industry very hard, including genre. So it was a challenging period.
But it turned around.
Yes, largely thanks to Ajit Jain, who Buffett praises constantly. He took charge of the reinsurance operations and really turned things around. By 2003, they were profitable again, achieving a negative cost to float, making money on the underwriting, and having the float to invest.
Impressive turnaround. Beyond insurance, Berkshire started buying whole businesses in all sorts of industries. What was the checklist for those acquisitions?
It boiled down to three main things, really. One, businesses he could understand. Two, businesses with good long-term economics, often with some kind of competitive advantage or moat. And three, critically, management he could trust and admire.
Can you give some examples that fit that mold?
Sure. Benbridge Jeweler, family run, trusted management staying on, that was key. Or Justin Industries, making boots and bricks seem like commodities, but they built strong brands, franchises.
So finding quality even in seemingly mundane areas.
Exactly. Benjamin Moore paints solid brand, needed a bit of a refresh, good leadership. Shaw Industries, dominant player in carpets.
What about Clayton Homes? That's manufactured housing, a tough industry.
Right. But Buffett saw it was exceptionally well-run, very disciplined financially. He famously trusted the management so much he did the deal largely over the phone.
Wow. And McLean Company,
Yeah.
the pampered chef.
McLean was distribution strategic fit, growth potential. Pampered Chef was direct selling, consistent growth, resilient model. All fit those core criteria. Understandable, good economics, trusted management.
So the same logic applies when Berkshire buys stocks in the public market, not just whole companies.
Pretty much identical. Understandable business, good economics, trustworthy managers. Look at their big holdings back around 2003, Coca-Cola, Gillette, Wells Fargo. You know what they do?
Coca-Cola is the classic example, isn't it? He'd known it forever.
Yeah, he saw its global power building for decades. But he didn't buy big until 1988, really recognizing the strength of that brand and, crucially, its worldwide distribution system. That was the moat.
And Gillette, people thought it was maybe past its prime.
Some did, yeah. Seemed mature. But it had huge market share. And then, boom, new products like the Sensor Razor kicked off a big turnaround. Buffett was on the board, saw it happening.
The Washington Post Company. That seems like a special one. Long holding, big success, built his reputation too.
Absolutely. He met Catherine Grant at 71, was incredibly impressed, invested in 73. That investment grew something like 50 times by the early 2000s.
Incredible.
And he wasn't just a passive investor. He advised Kay Graham, supported them through things like the Pentagon Papers, mentored her son Don. It was a deep relationship, and yes, the success really cemented his image.
Okay, let's break down those investing guidelines more formally. First, the business tenets. What are the rules about the business itself?
Rule 1. Is it simple and understandable? He avoids complexity, rapid change he can't predict. Rule 2. Does it have favorable long-term prospects?
Meaning?
Meaning it's likely to be earning more money 10, 20 years from now. He looks for franchises with those wide, sustainable moats, durable competitive advantages.
Like a brand name or low-cost production.
Right. Things that protect it from competition. And a key sign of a strong moat. Pricing power. Can they raise prices without losing lots of business? That's huge.
Anything else on the business side?
Yeah, he likes a consistent operating history. He's wary of companies constantly needing turnarounds because their basic business isn't working.
Makes sense.
No.
Okay, next. Management tenets. What about the people running the show?
This is non-negotiable for Buffett. He has to invest with managers who are honest, competent, and whom he genuinely admires and trusts. He says he won't partner with people he doesn't like, no matter how good the business looks.
High standards. What specific qualities does he look for?
Candor is big. Can they admit mistakes? He points to his own discussion of the genre issues as an example. Rationality, acting in the shareholder's best interest.
Right, aligning management interests with owners. How does he gauge that?
He looks at things like compensation plans. Do they reward long-term value creation? He admired Roberto Goizueta at Coke for that. He also looks for managers who resist the institutional imperative.
The what now?
The tendency for companies to just copy what everyone else is doing, even if it's dumb. Like making acquisitions just because rivals are, or expanding recklessly. Clayton Homes resisting bad lending practices was an example.
So, independent thinking. How do you figure all this out about management?
Read their past communications.
Ah.
Especially annual reports. How do they talk about successes and failures? Are they straightforward? That tells you a lot.
Good advice. Let's move to financial tenets. What numbers does he focus on?
He looks hard at return on equity, ROE. How effectively is the company using shareholder money to generate profits? But not just reported earnings. He focuses on owner
Owner
earnings.
earnings, right. That's net income plus depreciation amortization minus.
Minus the real capital expenditures needed to maintain the business's competitive position long term. It's a truer measure of the cash flow actually available to the owners.
So it accounts for the money you have to reinvest just to stay in business.
Exactly. Unlike just looking at, say, EBITDA or even basic cash flow, which can be misleading if a company has huge capital needs.
Got it. And finally, the value tenets. This is where the price comes in.
This is where it all comes together. The absolute foundation is the margin of safety. You must buy at a significant discount to your estimate of intrinsic value.
Which requires estimating that intrinsic value in the first place.
Right. Using methods like discounted cash flow, looking at earnings projections. He uses a consistent discount rate, often the long-term government bond rate, to bring those future earnings back to present value.
And when do the best opportunities appear?
Often, it's when a truly excellent company hits a temporary stumbling block, bad news, an industry scare, something that makes the market price dip below intrinsic value for a while. That's when you can step in, like with Larson Jewell, the picture frame company he bought. Find value where others aren't looking or are panicking.
Interesting that he also applies this thinking to fixed income, to bonds, not just stocks.
Yeah, when bonds offer better value than stocks, he'll allocate capital there. But he looks at them the same way, like buying a piece of a business. He analyzes the issuer, the company, or entity borrowing the money. Is management sound? Are its finances solid? What are its values? He did this with Washington Public Power Supply System bonds when they were trading at a big discount. He bought high-yield bonds opportunistically when the market tanked. He even uses things like convertible preferred stocks, which have features of both stocks and bonds. Same value mindset applies.
Okay, so you find good investments. How does he think about putting them together, managing your portfolio?
He's a huge advocate for focus investing. Don't spread yourself thin across dozens of mediocre ideas. Concentrate your capital in a smaller number of truly outstanding businesses that you understand really well and that have great management.
Fewer bets, but higher conviction bets.
Exactly. He has these focus investors' golden rules, basically.
Yeah.
Concentrate, know what you own, think long term. It's very different from modern portfolio theory that preaches diversification above all else to reduce risk.
He thinks concentration, if done right, reduces risk.
Yes, because you know the businesses so well. He points to other successful investors like Munger, Bill Ruane, Lou Simpson. They all ran concentrated portfolios with great long-term records and very low turnover.
Low turnover, meaning they don't buy and sell very often.
Right. And that's a huge advantage. You cut down on trading costs, brokerage fees, and crucially, you defer capital gains taxes. Those unrealized gains keep compounding tax-free within the portfolio. Buffett calls it an interest-free loan from Uncle Sam.
Clever way to put it. We've talked a lot about analysis, but what about the mind game, the psychology of money? That seems critical too.
Oh, it's absolutely huge. Buffett and Munger understand human nature so well. They know how fear and greed drive investors to do irrational things, buy high in euphoria, sell low in panic.
Been there.
Haven't we all? Overconfidence is another big one, thinking you know more than you do. They also see how the constant barrage of news, the frequency of information, can push people into making short-sighted decisions.
And things like mental accounting.
Yeah, treating money differently depending on where it came from. Or just your basic risk tolerance influencing everything. Buffett's strength is his rationality. He relies on his research, his long-term framework, not gut feelings or market noise.
Which makes him a contrarian, doesn't it? The unreasonable man, as the book puts it, willing to go against the herd.
Totally. He sees the danger in just following the crowd, which is so common in finance with its short-term focus. He cares about how the business is doing over years, not how the stock is doing over days or weeks.
Turn off the stock market, he says.
Pretty much. Don't let Mr. Market dictate your actions. You're buying a piece of a business. Think like an owner with a 5, 10, 20-year horizon. Manage your portfolio like you're managing a collection of actual businesses, picking the best ones you can find, not just diversifying for diversification's sake.
When you break it down, it sounds almost simple. Understand accounting, read a lot, have the right temperament, stick to what you know.
Buffett himself says it's not rocket science. But simple isn't the same as easy, right? The intellectual part is one thing. The emotional discipline to stick with it, especially when you look wrong in the short term, that's the hard part.
Yeah, Hagstrom talks about his own journey trying to apply it, intellectually getting it versus emotionally doing it.
Right. And just copying Buffett's stock picks doesn't work. You have to internalize the principles and apply them yourself to find opportunities within your own circle of confidence.
So wrapping this deep dive up, if you, our listener, take away just a few core ideas from the Warren Buffett way, what should they be?
Okay, number one, really understand the business you're investing in. Two, analyze management closely. Are they capable and trustworthy? Three, think long-term, always. Four, demand that margin of safety, buy below intrinsic value. Five, stay rational. Control your emotions. Don't let fear or greed drive your decisions.
Finding great companies takes work, no doubt. But figuring out if they're worth buying at today's price, that comes down to applying those principles again and again.
Exactly. And these ideas, they're not fads.
Mhm.
They've worked for decades across all sorts of industries and market ups and downs. They're pretty timeless.
So here's something for you to think about. How can you start weaving these principles into how you make investment decisions? How can you shift your mindset from just trading stocks to actually being a part owner of businesses for the long haul? Maybe explore some of these concepts further. Thanks for joining us on this deep dive.